Today, we're digging into a massive $60 billion decision facing one of the biggest entertainment companies on the planet. Seriously, how Disney decides to invest in its theme parks right now is going to define its legacy for a whole generation. So let's break down this incredibly high-stakes dilemma. To really get what's at stake here, you have to start with this number, nearly $9 billion. That's the operating income from Disney's Parks division in a single year. It's just a staggering amount of money, and honestly, it's the key to understanding the entire company right now. You see, that incredible profitability has basically turned Disney's experiences segment, that's the parks, cruises, all that stuff, into a financial fortress. While the company's been pouring billions into the streaming wars, the parks have been the reliable, cash-gushing engine keeping the whole kingdom afloat. And just look at the numbers from fiscal year 2023. It's a tale of two Disneys, really. The experiences side brought in over $32 billion in revenue and almost $9 billion in operating income. That's a pretty healthy 16% margin. Meanwhile, the huge, expensive push into streaming, it's been massively subsidized by how well the parks are doing. This fortress isn't just strong, it's literally holding up the rest of the company. So how in the world did they build this fortress? Well, the answer is this really powerful business strategy that has completely reshaped the park experience over the last decade. It's called the franchise flywheel. The idea behind it is actually brilliantly simple, but man, is it effective. Disney uses its blockbuster movies, we're talking Marvel, Star Wars, to build these huge emotionally invested fan bases. And then it captures that devotion by building these incredible immersive worlds in its theme parks where fans can go and live out those stories. And, spend a lot of money on tickets, food, and merch along the way. Here's how the cycle works in practice. Step 1, you release a monster hit film like The Force Awakens. Step 2, you build a billion-dollar land like Star Wars Galaxy's Edge, where fans can actually pilot the Millennium Falcon. And Step 3, you sell them their very own custom-built lightsaber. See? Each part just feeds the next, creating this amazing, self-sustaining profit machine. And has it worked? Oh, absolutely. Per capita guest spending, that's just the average amount each and every visitor spends, is up over 40% compared to right before the pandemic. It just goes to show that fans are more than willing to pay a premium to actually be a part of the stories they love so much. But, and this is a big but, here's where a case study gets really complicated. This incredibly successful model is starting to show some signs of strain. We're seeing signs of fatigue, both inside the parks and out. So this chart, this shows that incredible 40+% jump in what people are spending. From a purely financial point of view, the franchise flywheel has been a home run, a roaring success. But that success has come at a cost. And here's that cost. While people are spending more money, they are not all happy about it. Complaints are going up about just how expensive and complicated a Disney trip has become. For some people, that premium experience is starting to feel a lot more like just a premium price tag, maybe without all the premium magic. And this isn't just a problem inside the park gates either. It goes all the way back to the very start of the flywheel. Recent franchise films, like the Marvels, well, they've underperformed at the box office. It's signaling what a lot of people are calling franchise fatigue. And look, if the movies that power the whole flywheel start to sputter, the entire machine is at risk. So this brings us to the core dilemma. Disney has announced this plan to invest a truly mind-boggling amount of money into its parks over the next decade, and that's forcing a decision that is going to shape its entire future. $60 billion. That's the amount of capital Disney plans to pump into its parks and cruises. This isn't just a fresh coat of paint. This is a fundamental decision about the very soul of the Disney theme park experience for decades to come. So the huge question is, where does that money go? How do you use $60 billion to turbocharge the parks when your main strategy is starting to show some cracks? And this, well, it leads to two very, very different paths. Okay, so on one hand, they can double down. This means more Marvel, more Star Wars, more of what's been working. It's definitely the safer bet for a quick return on that investment. The other path is to diversify. This means maybe investing in totally original ideas or digging into some of those classic properties they haven't used as much. Like, imagine a whole land dedicated to Disney villains. It's a way to hedge against franchise fatigue, broaden the park's appeal, but it is a much, much riskier long-term play. So now let's put you in the hot seat. Imagine you're the CEO of Disney. The $60 billion checkbook is open. What's the right move for the long-term health of this company? This is the strategic trade-off they're facing. Doubling down on the proven hits is the safe financial move. But the risk? You could erode what makes Disney, well, Disney. If every single corner of the park is based on the latest blockbuster, does it start to feel less like a magical kingdom and more like a generic IP mall? Ultimately, it all boils down to this one really provocative question. Do you keep squeezing every last drop of profit from the Marvel and Star Wars golden goose, knowing it might not last forever? Or do you take a massive $60 billion gamble on trying to find the next one? That is the question.